The broadcast is now starting. All attendees are in listen-only mode.
Good everyone, and welcome to the webinar with Merchant Tech. My name is Janelle, and before I hand over to Dani, who's going to be your host today, I just want to make sure that everyone can hear me. So if you can hear me, could you please lift your digital hand? It'll be the hand icon that's next to your name. All right, let's see some hands. Dani, hi, over to you.
Thank you, Danielle. Hi, my name is Dani Kloppers, and I'm presenting on behalf of Merchant Capital. Our research team covers a universe of approximately 50 mid and small cap stocks, and have been doing so for Standard Bank for the past 6 years. Our research is available on the Standard Bank online platform. In today's webinar, we will briefly look at the performance of the South African economy before discussing 5 small and mid-cap stocks. These are companies which have been plummeting following specific events, in which the market has been keeping on a low rating. But we believe these stocks have notable upside potential and are likely to experience a re-rating. We will also discuss 2 new companies that we recently added to our coverage. If we look at the overview of the South African market, we'll see that the past couple of years have been particularly difficult for the South African economy, which is on the verge of a credit downgrade, together with trade wars that's slowing economic growth. There's power failures and political instability in the country, and some spectacular price decreases of JSE market darlings, which have led many South Africans to reduce investments in the local market. During 2018, South Africa's GDP increased by 0.8%, which was slightly higher than expectations. And despite the slow growth, analysts say that the outlook for the economy is likely to improve in 2019, with a GDP growth expectation of 1.5%. Economic indicators show that South Africa will need to sustain growth of at least 5%, in line with the National Development Plan, to make a meaningful dent in the unemployment rate, which is nearing the 3% mark. But overall, South Africans are slowly becoming hopeful about the economy. The rand off to a start in 2019 and a 2.2% GDP growth in the last quarter of 2018. More positively, there's a clear intention by government to lift growth and employment over the next few years. The government's commitment to restructure and support Eskom and other state-owned entities will play a critical role for economic growth. Weak consumer spending is already pressuring the country's retail sector. The JSE's retail index has lost more than 7% so far this year, while the overall JSE market has increased almost 8%. The small and mid-cap space has demonstrated weak performance relative to the all-share index over the past 12 months. Valuations and earnings have fallen dramatically as a result of the poor market sentiment. Negative investors scramble to get their liquidity offshore into larger rand-held stocks. And due to the thin analyst coverage of the small and mid-cap space, overpenalized stocks may remain below value for relatively long periods of time. So there is real potential to be unlocked when you invest in small and mid-cap stocks. It requires patience, but they can yield high returns, albeit with high risk. If we look at the graph, it shows our stock universe and how the space has been largely negatively impacted. A lot more small and mid-cap stocks showed declines since the beginning of the year, but we believe there is true intrinsic value to be found by investors who truly understand these businesses. Our stock universe trades at a historic PE of 2.6 with a forward PE of 7, showing the upside potential these stocks have. The small and mid-cap space is seen as having a bit more risk, while some stocks are less by general economic impacts. In January, top picks on the mid-cap universe for 2019 were Baldwin, Westgold, Vunani, Adapt IT, and EO8. These stocks took massive strain from the beginning of the year, together with the rest of the small and mid-cap sector. While we had previously mentioned that they are all relatively high risk, high reward picks, we believe that these stocks bear notable potential upside, with the exception of EO8, but we will take our view that the potential for upside outweighs the challenges associated with each of these stocks. Our first pick was Baldwin Properties. Since January 2019, Baldwin Properties entered into a right of first refusal agreement with Baldwin Rentals, in which Baldwin Rentals has been granted the right to acquire apartments from Baldwin Properties. The apartments will be sold to Baldwin Rentals at an approximate 30% margin. Baldwin Rentals will in turn derive annuity income from leasing them. The money paid by Baldwin Rentals for the apartments will be reinvested by Baldwin Properties into its existing development pipeline. We have updated our model to include the rental business, and our valuation on Baldwin remains undervalued. The Baldwin Fibre business and solar energy projects is also expected to make a meaningful contribution after 4 years. Our valuation on Baldwin is still looking extremely cheap, given the strong demand for its units and exceptional reinvestment plan. Baldwin is trading at a forward PE of 2.2, while the industry sits at a PE of 7. Our DCF valuation places Baldwin at a price of R4.11 compared to a current market price of R2.45. Forecast a PE price of R4.61. Westgold Holdings. The coal mining and trading group's share price has been taking a bit of strain and decreased 20% so far this year. We haven't seen anything to believe that our valuations are off, except the resignation of the group CEO and the reconstitution of the boards, which might have led to the decline in the share price. Things are on track for Westgold. They announced the acquisition of 50% interest in the Arnold mine and also made a Category 2 transaction earlier this year. We believe there is upside for the group. There is a favorable coal price, which we expect will further enhance earnings, and the group's mines are at a good production level. And the efficient performance of the Elandspruit and the Gautfontein mines are also playing a critical role. We forecast a DCF price of R4.75 and a PE price of R3.84, compared to a current market price of R1.55. Vunani Limited remains a promising pick. Since our last webinar in January, the group released an announcement detailing a deal in which Talos Limited has agreed to purchase 67% of Metlife Swaziland from Metropolitan International for an amount of 55 million. Vunani owns 78% of Talos, and the rest is owned by the senior management of Metlife. The deal is in line with Vunani's strategy to expand its financial services activities, especially in niche markets both in South Africa and across Africa. Metlife Swaziland offers long-term life insurance. The acquisition will further expand Vunani's presence in the insurance sector. Metlife Swaziland boasts a large percentage of annuity revenue, strong cash flow generation, high quality and diversified client base. The group has proven its ability to successfully navigate difficult economic conditions. And while we expect conditions to remain difficult over the short term, we see potential in the group's medium to long-term earnings prospects. Vunani's share price is up 25% so far this year, and we expect to see the share price approach the R3 level over the medium term. Next for discussion is Adapt IT. Adapt IT continues to show promise, and since our January webinar, the group has released its interim results which saw acquisitions continue. The group continues to make progress towards its 2020 revenue target of 3 billion annualized revenue. However, given the current economic conditions, which are expected to persist, we feel that this will be achieved around 2021 to 2022. AdaptIT acquired Connor Solutions, Strive's period, which has bolstered the group's new software services in the telecoms and education sectors. The group's revenue remains strongly weighted towards annuity-based income, and the group has maintained relatively high margins. Their strategy, which involves owning IP, has allowed the group to defend its margins during difficult economic period. Notwithstanding the difficult economic environment, we believe AdaptIT's share price is suffering some negative sentiment because of what happened to EOH. The size and acquisition model is far more conservative and different than that of EOH. Our DCF valuation places AdaptIT at a price of R8.65, 68% upside to the current market price, and we forecast a PE price of R8.21. The next slide is on EOH Holdings. At the beginning of the year, we felt EOH had the opportunity to turn around, but the events that unfolded around corruption allegations led us to believe otherwise. EOH's share price decreased almost 50% so far this year. The latest price collapse is owing to further and what looks like substantial misconduct in the group. The share price has suffered as a result of Microsoft giving notice that it wishes to terminate its contracts with the group. Following the announcement, EOH shares lost over 34% of their value and reached an 8-year low. The group's new management team has not been able to convince the market of their turnaround strategy, and it remains uncertain whether the group can cut costs and do this off of a shrinking revenue base, as more and more corporates might decide to terminate business with EOH. So we feel that there's too much uncertainty around EOH, and therefore caution investors to stay away until further clarity emerges. It's just too much risk at the moment. Quantum Foods, one of our latest companies we cover, is a diversified agricultural business providing quality animal feeds, eggs and poultry to selected South African and African markets. Quantum has a strong balance sheet with very little debt, which provides the groundwork for organic growth by reinvesting the excess cash. In difficult economic times, the group will not see hefty finance charges, nor be able to utilize its cash to effectively manage working capital. The group performed exceptionally well in its 2018 financial year. It saw EBIT more than double as a result of tailwinds experienced within the eggs business. The bird flu in 2017 and beginning of 2018 resulted in a shortage of eggs, which caused egg prices to increase by approximately 24%. However, margins were already lower in the second half of the financial year due to an increase in the price of animal feeds and lower egg prices, which have begun to revert back to historic levels. As the average income per person declines, consumers move away from meat in order to stretch their budgets. But poultry meat is seen as an affordable alternative to pork and beef, and demand for poultry within South Africa remains high. According to the latest economic data, chicken prices are decreasing from oversupply in the market as a result of cheaper imports. We expect lower revenue from the group's chicken farming division as a result of the lower prices. Quantum's animal feeds division, which sits at an EBIT margin of 5%, will see revenue increase as a result of the higher maize prices, and we do expect a further increase in volumes as poultry livestock recovers. The group's operations in Zambia, Uganda, and Mozambique benefited from favorable macroeconomic conditions in all three countries, which resulted in revenue increasing by 8.8% to 420 million. Zambia and Uganda have climatic conditions which are well suited for poultry farming, and Mozambique's egg industry experienced similar conditions to South Africa, which saw the Mozambique business post its first profit. The EBIT margin increased from -4.6 to 14% due to the favorable trading conditions, including a sharp increase in egg prices. The group's successful business model and geographic footprint is well intact, and the favorable market conditions are expected to deliver sustainable returns for investors. We forecast the DCF price of R4.52 compared to a current market price of R3.44. On a PE basis, Quantum share price is undervalued with an implied PE price of R5.14. Our last company for the discussion is New World Holdings. New World provides a diversified range of electrical appliances, consumer electronics, and branded consumer durables. The group has been listed on the JSE for more than 50 years. The primary business of New World is importing, assembling, marketing, and distribution of consumer goods, including electronics, high-tech, liquor, and furniture. The group's revenue went over 3 billion for the first time as a result of an 11.4% increase in revenue, which was offset by lower sales by its offshore subsidiaries. The retail sector is currently one of the worst performing sectors due to constrained consumer spending. The retail sector has lost more than 7% so far in 2019. However, given New World's mix of products, it looks as if they can show better earnings compared to other retail sellers. The Consumer Confidence Index shows that consumer confidence is above the long-run average, which indicates that consumers are fairly optimistic about the outlook for the South African economy and their own household finances. However, in order for consumer spending to increase significantly, household income and credit growth will need to accelerate. New World is currently trading at a PE of 5, despite the share price increasing by over 10% in the past 12 months. The group has consistently demonstrated its ability to successfully navigate the South African retail space despite the difficult economy. Valuation on New World. Our DCF valuation places New World at a price of R45.79 compared to a current market price of 41. On a PE basis, we believe New World is undervalued with an implied PE price of R62.60. This concludes our presentation today, which I'd like to thank you all for joining in on. If you would like more in-depth information on any of these companies or any other company in our coverage, you can find our reports on the Standard Bank online platform. Please refer to our disclaimer. If there's any questions, please don't hesitate to ask. Thank you.
Thank you, Donnie, and thank you to everyone for joining. Donnie, I've got a question from EJ about Eskom. And EJ just wants to know, how would the uncertainty about Eskom affect Westcoal?
Pardon, Danielle, please repeat that question.
EJ would like to know, how would the uncertainty about Eskom affect Westcoal?
So, thanks for that question. I'm now going to give over to Brian to answer us that question. Thank you.
Hi, it's Brian Rainier here, head of research at Merchant Tech. Yeah, we've spoken to the company about that, and essentially they have very strong contracts in place with Eskom. And essentially from everything we're seeing, Eskom is under huge pressure to acquire as much coal as it can. So, it actually favors suppliers like Westcoal, providing coal into the power stations. So, yeah, we, other than a complete failure of Eskom, which is just too, horrendous to contemplate, we think Westcoal is still in reasonable shape with its supply contracts. They certainly have not had a problem, and they have always been paid on time.
Thank you very much, Brian. I don't see any other questions. So, Donnie or Brian, if you just repeat the details, should anyone want to get a hold of you, please?
Sorry, Daniel, what did you say?
If you could just repeat your contact details, should anyone want to get a hold of you or contact you with queries.
Sure, yes, they can contact us at, it's on this last slide over here, midcapresearch@merchantech.co.za. Alternatively, they can get hold of the team at Cape Town, 534-1241.
Donnie and Brian, thank you very much for joining us and for a lovely informative presentation. And thank you to everyone for tuning in. As Brian and Daniel said, if you have any questions, please do not hesitate to contact them directly. Otherwise, you can also send us an email at securities@standardbank.co.za. Thank you, everybody, and goodbye.
Thanks, bye.